Hello, everyone, and welcome to today's class on financial statements, cash flows, and taxes. I hope all of you are doing well. So, we have in the past discussed that for this cause of figuring out the value of an asset, we will be needing to calculate usable cash flows that a company is generating, and that we will be discounting those cash flows at a discount rate known as WACC. So we kind of know that cash flows are very important for the purpose of calculating the value of an asset of a company. And of course, since it's important for that, it's also important for the financial management course, because one of the key goals of the course is to really be able to calculate the value of firms. So that being said, if we were to talk about the value of any asset in any firm, the value of that any asset in any firm is going to be the after-tax usable cash flows that the asset is expected to produce. So the asset, any asset, is going to be as good as the usable cash flows that that asset is going to produce. So since you all are students of BBA 6 and you've already taken several finance and accounting courses in the past as well, I am going to kind of just skim through a lot of what can be deciphered from financial statements and reports. Most of you already have a good working knowledge of all of this information that I will be discussing with you in the next couple of slides. So the first thing is that an annual report in general, any annual report of a company, is used by investors of the company to form expectations about future dividends and earnings. And so if there is a public company, they usually make their annual reports. In fact, they always make their annual reports public. And looking at those annual reports and the information that is being made public by a company, investors can decide whether or not they want to continue to hold on to the shares that they already have of the company, sell them, buy more, and all of that. Those decisions will be basically based on their expectations, based on what is being indicated in the annual report. Now, if you look at any annual report, it has two basic sections. One is a verbal section, and in the verbal section, it describes the operating results, the new developments of what is happening in any firm. And then there's also a financial accounts information section. And in this section, it really, just shows the balance sheet, the income statement, statement of retained earnings, and statement of cash flows. Now, just recently, I was looking at the annual report of Engro fertilizers, and must say that they have actually won an award for having one of the best annual reports in Pakistan. So I would definitely suggest that you have a look at that, just to get an idea of the kinds of annual reports that are published. And that will give you a very good idea. I might show it in class as well, rather briefly, just to review it with all of you. So now I'm going to show you, on this slide, a balance sheet. And in this balance sheet, the assets are at the top and the liabilities and equity is at the bottom. And, as you all know, the assets must equal to the liabilities plus equity. So the total value, it balances out on the balance sheet. Now, this is an example where the assets are on the top and the liabilities and equity is at the bottom. But sometimes it may just happen that the assets are on the left-hand side and the liabilities and equity are on the right-hand side. So these are just formatting changes, but I just kind of wanted to sort of point that out to you. One thing you will note in most cases, there is always at least a 2-year balance sheet given. Same for income statements, they're for 2 years usually, and cash flows and retained earnings statements as well. And the reason is that they want to make it very easy for investors to make a comparison of what happened last year versus in the current year. And so these are just some basic things that I wanted to point out regarding balance sheets. So what are balance sheets, and what is the objective of them? Well, a balance sheet is like taking a picture or a snapshot of the financial position of an organization on the last day of the year. So it's basically the situation on December, let's say 31st of any year, if that's the calendar year that the company is following. And one thing to also notice is that usually things are shown, the way things are listed on a balance sheet is in order of liquidity. So you'll see, for example, if you look at the asset side, you're going to see things such as cash as the number one entry in the assets. Why? Because it's the most liquid. And then you'll see account receivable and inventory and things like that, right? And what you'll see at the bottom of the assets list is going to be the fixed plant and equipment, for example, because those are hard to sell, they're not very liquid. So that's just something to keep in mind. And also, in terms of liabilities, well, what are liabilities? Liabilities are basically claims that other groups have on the company's value. So let's say, it's basically things that the company owes to other people. So, other people can make a claim that, look, this company owes us something. All of those things are considered liabilities. And as far as stockholders go, because remember, it's the main, the assets have to equal liability plus stockholder equity. Well, as far as stockholders go, they are, once all the liabilities have been paid off, then the stockholders are paid the remaining amount. So that's kind of something just to keep in mind. Also on balance sheets in general, the book value of assets is shown as versus the market value. So the book value is always going to be the original price of, let's say, an asset minus the depreciation. And that is the book value. Now, if you go into the market and look to buy something, or what the market value of the asset that you have in hand right now is, it may be different or similar to the book value, but they're two different things. So generally so always on the balance sheet, you will see book values. You will not see market values. Current assets are assets that can be converted into cash within a year. Similarly, current liabilities are liabilities that you need to pay off within a year. Fixed assets, on the other hand, those are things, assets that it would take maybe longer to sell, longer to convert into cash, more than a year. Similar with current liabilities, maybe these are long-term liabilities that are due in more than a year. Also, one thing to keep in mind when we're looking at assets on the income on the balance sheet is an item by the known as inventory, and you all know what inventory is. And just from your accounting courses, you must also remember that inventory can be valued in many different ways. So it can be valued by FIFO, LIFO, weighted average. There are many different ways. And the accounting method that you use to value inventory does make a difference on your net income and your taxable income, all of that. So these are just things to keep in mind. Also, depreciation, I kind of mentioned that a little while ago as well. And again, since you've studied accounting in previous courses, I'm sure you're very comfortable with the whole idea of how a value of an asset that you buy over a number of years depreciates or goes down. So, you know, and I'm not going to go into the details of how depreciation is done since you all are already familiar with that. But net depreciation expense is when purchase cost is spread over assets' useful life. Those are just some things to keep in mind about the balance sheet, about assets on the balance sheet. Okay, so I kind of covered a few of these points in the previous slide already, but just to reiterate, you know, there's going to be current liabilities, and those are liabilities that you are expected to pay within a year. And long-term liabilities, you're expected to pay in more than a year. If you ever see something known as preferred stock, that is a cross between common stock and debt, just just for your information. And also something interesting, a definition is retained earnings. And retained earnings are earnings that have not been paid out as dividends. So the company is holding on or retaining their earnings. They are not paying it out as dividends if they have any retained earnings. Common equity, there's a word by the name of common equity, and common equity basically means retained earnings and common stock. This is also known as the net worth. Okay, next I'm going to talk to you a little bit about income statements. And here on the side, you can see an income statement. And you have your net sales, right here at the top. And then you have your cost of goods sold, except depreciation. And so basically, cost of goods sold is basically the cost or the expenses that it took to make the goods that have been sold. And then after that, depreciation and amortization is subtracted. So if you just took net sales minus cost of goods sold, that would give you something known as EBITDA, earnings before interest, taxes, depreciation, and amortization. So that would be net sales minus cost of goods sold. And then if you actually subtract depreciation, amortization, and other operating expenses, then you would get something known as EBIT, which is also known, stands for earnings before interest and taxes. And if you subtract, interest from there and taxes, then right at the end, you're going to get your net and also the dividends that you're paying out. Then you would have your net income available to common stockholders. Okay. So these are just some important things to keep in mind. As you can see over here, it's again, the income statement has been given for 2 years, just for comparison purposes. It makes it easier for investors to compare year-on-year performance of an organization this way. Okay, so I had kind of just, just a minute ago or so discussed what EBITDA is, earnings before interest, taxes, depreciation, and amortization. I've kind of just mentioned it on this slide as well. Again, it's net sales minus operating costs, and you do not want to exclude depreciation and amortization when you are calculating EBITDA. Net income is going to be your revenue minus expenses, taxes, preferred dividend, and this is the dividend that is before the common dividend. So if you take revenue and you subtract all of these things, then you are going to get net income. And to calculate the profit or earning per share, the formula is the net income divided by number of shares. Okay, next I'm going to talk to you on this slide a little bit about statement of retained earnings. And if you recall, I mentioned that retained earnings are the earnings that the company holds on to and they do not pay out as dividends. So if we over here on the slide, you can see that the retained earnings in this case, as of December 31st, 2015 were 800. And then the company made a net income of $220. So that was something positive. And then they decided to pay out, cash dividend of 50. So if you wanted to calculate the balance as of 31st December 2016, it is 800 plus 220 minus 50, which is 970. And so this is how retained earnings is calculated. And retained earnings are claims against assets. So I'm going to start talking to you a little bit about cash flows. And the first thing I want to talk to you about is net cash flow. And net cash flow, if you have to, the formula for net cash flow is net income minus non-cash revenue. And this basically is known as deferred tax in many cases, plus non-cash charges, which includes depreciation and amortization. Another way to calculate net cash flows is taking net income plus depreciation plus amortization. So on this slide, I'm showing you a statement of cash flows, and some things to keep in mind over here is that it's broken up in different parts, right? So there are three major parts of any statement of cash flow. The first one is operating activities. And next is investing activities. And the third one is financing activities. So obviously, just by virtue of their name, operating activities has to do with their daily, all the cash that's going into the daily day-to-day operations of the organization. And here you can see that it includes, non-cash adjustments such as depreciation and working capital. The next section is investing activities. And this is basically things such as cash used to acquire fixed assets, because again, investing when you're buying fixed assets, and also if you're selling some investments. So anything related to investments will be coming into this section. And then there's the financing activities. And that's all about, when you're let's say increasing your notes payable or increasing the bonds, maybe the company has bought some bonds. So if those are increasing, any sort of financial related activity is reflected in the financing activity section of the cash flow statement. This slide is pretty much a repeat of what I just kind of mentioned. The statement of cash flow summarizes changes in any company's cash position over the year. There are three categories. The first one is operating activities, and this includes net income, depreciation, change in current assets and liabilities other than cash. The second one is investing activities, and this includes investments and fixed assets. And finally, there's the financing activities. This includes raising cash by short-term, long-term debt or stock. Financing activities also includes dividends paid, cash used to buy back stocks or bonds. Okay, one thing to remember is that net income of any company is different from the cash position. Net income is something that can be used in a number of different ways. It can be used to pay dividends, buy inventory, finance account receivable, invest in fixed assets, reduce debt, or buying back debt. But it is different from the cash position of a company. Now, if we look at things that can affect the cash position of a company, these include several things such as net income before preferred dividend, non-cash adjustment to net income, and this must be just net. It's so there's an adjustment that needs to be made for deferred revenue, depreciation, amortization. So all of those things do affect the cash position. Also, changes in working capital, increases such as increases in current assets, increase in current liabilities, all of these things also have an impact on a firm's cash position. Then there's investments. And so if there's an increase in fixed assets or increase in such as, things such as short-term financial investments, those things impact the cash flow statement, and also security transaction and dividend payments. So these are some of the things that impact the statement of cash flows or the cash flows of any company. Okay, so couple of things to keep in mind. Generally speaking, financial statements are more for managers and stock analysts. Okay, so the target market for the annual reports are basically people evaluating the stocks, such as investors and managers. But if somebody has to make some sort of corporate decision making, then certain modifications need to be made to the these financial statements, such as cash flows, right? So just in a little bit, we are going to be learning how to calculate free cash flows. So those free cash flows are different from the cash flow statement per se. And those free cash flows are then going to be used to figure out the value of a company. So this diagram over here gives you a high level map of how you're supposed to calculate the free cash flow for an organization. So there are two basic things you need to have to calculate the free cash flow. And this is your ultimate objective. First thing, you need to calculate the net operating profit after taxes. I'll just show you how to do that. And then you have to subtract from that the net investment in operating capital. And to calculate that, you have to take step 2, step 3, step 4. So for the first section, and you can see it's in kind of blue, right? And so step 1 is generating the net operating profit after taxes. And all step 2, step 3, step 4, all of that is generating the net investment in operating capital. And the difference between the two gives you the free cash flow. So let's look at how, first of all, you calculate the net operating profit after taxes. This is EBIT, or earning before interest and taxes, and you multiply it by 1 minus the tax rate. And that will give you the net operating profit after taxes. Now, to figure out the net investment operating capital, you have to first find the net operating working capital. And then you find that by taking the operating current assets minus the operating current liabilities. And then you take the net operating working capital and you add the operating long-term assets. And that is going to give you the total net operating capital. And then from the net operating capital, you subtract the net operating capital of last year, and that will give you the net investment in operating capital. So net, when you take net operating profit after taxes and subtract net investment in operating capital, you will get the free cash flow. So this slide, again, is kind of just helping you. It's a little bit of repetition over here. First things first, it shows how to calculate the net operating working capital. This is operating current assets minus operating current liabilities. Operating current assets are assets needed to operate the business. They include things such as inventory, and they are different from long-term operating assets such as plant and equipment. All right, now non-operating assets are cash and short-term investments above the level needed for normal operations. So that being said, next thing you need to calculate, first you calculate the net operating working capital. And then once you have that, you add on the operating long-term assets, such as plant and equipment. And that is going to give you the total net operating capital. You will be seeing something known as NOPAT, net operating profit after tax, and this is basically EBIT multiplied by 1 minus the tax rate. Okay. And remember, this is the blue part, the blue thing that we had shown in the previous slide. And all of this that we're talking about, this is all the gray section. Okay, so now this is the formula for the net operating, total net operating capital. Now that you've calculated the net operating capital, you need to calculate the net investment in operating capital, which is the year-on-year change in the net investment in operating capital. So you will take the net investment in operating capital for 1 year minus the net investment in operating capital for the last year, and that will give you the net investment in operating capital. And to find the free cash flow, what you have to do is take NOPAT. And I just showed you how to calculate that. The blue portion, which is EBIT multiplied by 1 minus the tax rate, and then you subtract the net investment in operating capital. Also, a couple of other things to keep in mind. Gross investment in operating capital is, the formula for that is net investment in operating capital plus depreciation. And operating cash flow is also equal to NOPAT, which again is EBIT multiplied by 1 minus the tax rate plus depreciation. Now, calculating free cash flows, it's very important for this course. So it is important for you to understand exactly how it's done and to understand the whole methodology. Free cash flows in general, they can be used for a number of things. They can be used to pay interest to debt holders, repaying debt holders, paying dividends to shareholders, repurchase of stock from shareholders, and buying short-term investments or other non-operating assets. Okay, so I mentioned this several times. I'm mentioning it again. The value of, when you're finding the value of a company, it depends on it is basically taking the future cash flows or future free cash flows rather, which we've just learned how to calculate. And you have to sort of take their present value, and the interest rate that you discounted at is going to be the WACC, weighted average cost of capital. And so that's how we are going to be finding the value of companies. A couple of other things to keep in mind. Free cash flows are cash available for distribution to investors. And also a negative free cash flow is not always bad, because it may be that the company is investing a lot in, let's say, plant and equipment, for example. And so there's a lot of cash going out, but that's not necessarily a bad thing. Because it may lead to a big boost in their profitability in the coming years. So next, I want to talk to you about figuring out whether or not growth is profitable. If a company is growing, is it good? Is it bad? Is the growth profitable or not? And to calculate that is you calculate something known as ROIC, and the formula for this is NOPAT divided by operating capital. And if this value is greater than the WACC, then the firm is adding value and their growth is profitable. All right. Now, next I'm going to talk to you about something known as market value added, or MVA. And the market value of a stock is basically equity capital supplied by shareholders. In order to calculate this, there are a couple of formulas. One is shares outstanding multiplied by the stock price minus the total common equity. Another formula is total market value minus total investor supplied capital. And yet another formula is the market value of stock plus market value of debt, which is the book value of debt, which is taken as an estimate, minus the total investor supplied capital. And this is basically the sum of equity, debt, and preferred stock. That would also give you the market value added. To find something known as the economic value added, the formula is slightly different. And if you want to understand exactly what economic value added is, it is basically something that measures the extent to which shareholders' value has increased. It is used for performance over the year and individual divisions performance. On the other hand, the MVA, which we just calculated, the market value added, is to understand how the organization has performed over its life and the whole organization. So again, economic value added is for, performance just over a year. And if you're looking at various individual or divisions, and market value added is, overall, how has the company performed over its life. So the way to calculate the economic value added is the, three formulas I'm going to be sharing. One is NOPAT minus after-tax dollar cost of capital used to support operations. Another formula is EBIT multiplied by 1 minus tax minus total net operating capital into WACC divided by after-tax cost of capital. And yet another third formula is operating capital multiplied by ROIC minus WACC. Towards the end of this chapter, there's a lot of talk about, calculating income tax, and I'm not going to go into too much detail about this topic because the way income tax is calculated varies from country to country. The book really talks a lot about how income tax is being calculated in the United States. Here, however, there are some definitions that I do want to sort of mention to you. Marginal tax is the rate of tax on the last dollar of income. Average tax rate is the average tax rate paid on all income. And after-tax income is calculated by taking before tax income minus before tax income multiplied by the effective tax rate. Generally speaking, tax systems prefer debt financing, and the pre-tax income to a $1 dividend is 1 divided by 1 minus the tax rate. And with that, I come to an end to this lecture. And in this lecture, the key takeaway was calculating free cash flows from a financial management point of view. That is extremely, extremely important. So thank you very much. And I look forward to discussing further with you in class.